Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, on one mutual fund per video to share how an individual investor like you and I can try to find out more about a mutual fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I am not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the FSSA Dividend Advantage Fund and the FSSA Asian Equity Plus Fund. It's actually the same fund, with minor differences. You know, same but different. I'll explain. Now, the first thing we need to figure out as an individual investor is where can we obtain information and documents on the fund. FSSA has been in the retail business in Singapore and Asia region for many years, so it has a comprehensive website with plenty of details on their funds for retail investors to explore. With the web link here, you can access FSSA's Singapore website easily. There is also a First Sentier Investors website that you can check out. I will talk about the relationship between these two entities shortly. This website can contain some interesting information that the FSSA website doesn't have. FundInfo is a global third-party consolidator and service provider for fund data and documents, and has information on at least 90% of the mutual funds offered in Singapore. So if there is a need, we will be checking the information on FundInfo as well. For these websites, you should be selecting Singapore Retail Investor or Private Investor settings. Other settings should not make too much difference, but if you are curious, feel free to explore the other settings. You can, of course, also get some information from your distributor, which is your bank or online platform that you buy funds from, as long as they have the fund on their offering list. And finally, the web is always readily available, waiting to answer your search queries. Before we go through the fund details, let's spend a quick moment to understand who the fund provider, FSSA, is and what they are good in. FSSA, that is a bit of a tongue twister to pronounce, actually has a complex history of rebranding and organizational change. If FSSA is a person, the story of how it came about would probably be worthy of filming into a K-drama. So, the story goes that maybe not too long ago, there was an investment company called Stewart Ivory and Company Limited. Our lead actor is the Asia team that was set up by Stewart Ivory to focus on investments in the Asia-Pacific region. In the year 2000, the Commonwealth Bank of Australia, or CommBank as they call it, acquired Stewart Ivory. CommBank combined all the offshore fund management business, including Stewart Ivory, and rebranded it into First State Investments, whereas the business in Australia was branded as Colonial First State Global Asset Management. In 2012, the Asia team decided to rebrand itself as First State Stewart. Then 3 years later in 2015, First State Stewart split into two separate entities. Our lead actor rebranded itself into First State Stewart Asia, or FSSA. The clone became Stewart Investors. In 2019, First State Stewart Asia rebranded again into FSSA Investment Managers, which is the entity that we see today. In 2020, Mitsubishi UFJ Trust and Banking Corp, an arm of MUFG, bought over the business from CommBank. They then rebranded First State Investments into First Sentier Investors. Through the years, First Sentier Investors also acquired additional investment teams to broaden their business. However, that's not important for this video. Our focus is on FSSA Investment Managers, our lead actor, that remains broadly unchanged in what they do throughout the years. So, FSSA was initially set up and currently is still a specialist team focusing on Asia and emerging market equities. They are well known in the industry to take a long-term investment view, focusing on quality names and pure bottom-up stock pickers. They also consider themselves as an early adopter of ESG and responsible investing. Given their relatively long history, FSSA holds a reputation of being an early entrant in various key Asia markets, including China and India, and continues to run these funds today. FSSA runs an autonomous business while leveraging on the broader First Sentier Investors franchise. While I couldn't find details on FSSA specific business statistics, they certainly are an important part of the $157 billion of assets under management at First Sentier's investors level. Next, I will spend a bit of time to explain why there are two fund names in the title of this video and what is their relationship. To make things a bit simpler, I will use the short form names or abbreviations of these two funds as per marketed by FSSA since many years ago. The Dividend Advantage Fund has a great marketing name of DIVA or DIVA, while Asian Equity Plus is just using AEP, the abbreviation. So what happens is that DIVA actually doesn't run its own portfolio, but instead invests completely into AEP. In mutual fund jargon, we normally call AEP as the master fund and DIVA as the feeder fund. This works a bit like a Russian doll, where DIVA is like an outer shell designed for Singapore investors, and inside is AEP that is the actual portfolio. So why is there such an arrangement? Let's start with AEP's story. AEP was incepted in 2003 and is a sub-fund under the First Sentier Investors Global Umbrella Fund plc, which is an ICVC domiciled in Ireland. The fund's primary share class is US dollars accumulation, as with most other Asia equity funds. There is a US dollar distribution share class as well, though it pays only about 2% yield. AEP's strategy is mainly long-term capital growth. The strategy does include finding companies with dividend growth potential, but generating high distributions is not the key objective. Now, my take of what likely happened for DIVA is that a year later in 2004, the team wanted to get a better market share in the Singapore retail market, and therefore considered to roll out AEP in Singapore. There are advantages to have a Singapore domiciled fund, such as getting into CPF's list of investments, etc., and there is no need to duplicate efforts. Hence, creating a Singapore feeder fund that invests directly into AEP was the way to go. The primary currency share class needs to be in Sing dollars though, to cater for the Singapore retail market. And for equity funds, the practice is usually to have the currency share classes unhedged. Additionally, there needs to be a marketing angle to attract investors. So the team probably decided to position the fund as a high distribution product. And at 4% distribution yield, that makes the fund on par with the dividend yields for the popular names in the Singapore stock market. The fund name needs to be changed as well to cater for the marketing angle. And as a result, the Dividend Advantage Fund was born. Now, you probably noted that the distribution yield of DIVA is double of AEP, which means the additional distributions are probably not from natural dividends from the underlying positions, but are extracted from capital. We will discuss this aspect more later. With over 20 years track record, DIVA and AEP have generally been successful in both marketing and performance. The current AUM of DIVA is just slightly below 5 billion Sing dollars, while AEP is at about 6.2 billion US dollars. That makes DIVA a sizable contribution to AEP. Now that we understand the relationship of DIVA and AEP, we will need to look at AEP details when it comes to fund strategy. AEP uses MSCI All Country Asia Pacific ex-Japan Net Index as the benchmark. If we use the equivalent iShares ETF as a guideline to understand the market, this index has a rather substantial allocation of more than half to the Greater China region. Technology stocks are the top sector exposure. And this is heavily skewed by TSMC alone, which is over 11% exposure, considering there are over 970 positions in the ETF. AEP's strategy goes for a high conviction approach by investing in only around 50 to 60 positions. This translates to a very high active share of about 78%. Additionally, the investment team adopts a long-term investor mindset, as they make investment decisions with a 3 to 5 year view, and their ideal holding period, once they are convicted in a company, is 10 years or more. What this means is that they spend a lot of effort to research, understand, and engage a company before deciding to add it into their portfolio, and thereafter continue to actively review the position. Much of the initial effort goes to the bottom-up stock picking approach that uses fundamental analysis of the company and frequent meetings with key stakeholders. In their core beliefs publication, it was mentioned that the team conducts over 1,500 meetings each year, which is substantial considering this is a small specialist team. The companies that the team looks for are quality companies with growth potential. Healthy dividend growth is one of the quality considerations, but not a necessity. A summary article of the FSSA 2023 forum provided some interesting statistics that give insight to what quality really means to the investment team. In the article, it was mentioned that at the fund portfolio level, the gross margin ex financials was 43%, which was significantly higher than the benchmark's 28%, and even higher than FTSE 100 and S&P 500, representing developed market equities. Operating margin was significantly higher than those comparisons as well. Last but not least, return on equity, one of the team's favorite financial indicator, was at 19%. That was also higher than the rest. As such, AEP is indeed having a high quality portfolio of holdings going by these statistics. Last but not least, the investment team often self-professes as contrarians. What this means is not that they deliberately invest in everything that most other people dislikes, but instead means that they have long-term convictions in the teams that they play and do not keep changing to go for the hottest team of the moment. Consumer spending and domestic banking are some of the themes that they have maintained for many years, and this directly reflects into their portfolio composition that differs from the benchmark, which we will talk about next. Taking reference from the September 2024 fact sheet of either AEP or DIVA, we can see the long-term themes that the investment team has adopted leads to some notable differences in the portfolio compared to the benchmark, though the fund remains well diversified. On geographic breakdown, the fund has lesser allocation in the Greater China region, in particular Taiwan and South Korea. In exchange, the fund overweighted in India, mainly due to the domestic India banking team that they subscribe to. The fund also has higher allocations into Singapore and Indonesia compared to other regional countries, which is partly a result of having fewer positions in a high conviction portfolio. Looking at sector breakdown, we can quite clearly see the effect of the long-term themes appearing, as financials, healthcare, consumer staples are the clear overweights compared to the benchmark. While there is an element of technology focus, the fund is not one that will go right into the newest generative AI company of the moment. Instead, long-term positions such as TSMC that is currently prospering serves as evidence that the fund is patient to wait for its fruits to ripe. The same goes with the top 10 portfolio holdings, that reflects the same companies mentioned in the long-term themes. It is useful to note that AEP and other funds managed by the same investment team has less than 20% turnover, which means changes in the portfolio are infrequent. Obviously, if you already believe you have selected and hold the best companies available, there is no need to keep making changes. Understanding the composition of the portfolio this way lets you be aware that the fund will likely remain the same in terms of its preferences and overweights and stock holdings, so that you can make a better assessment if the fund is in alignment to your thoughts. At over 6 billion US dollar AUM, AEP and DIVA is one of the most popular Asia ex-Japan equity fund for Singapore retail investors. It has also won several awards in the past. Last but not least, DIVA also provides quarterly commentaries that gives clear rationale on the changes in the portfolio, which is extremely useful. The FSSA team is small and currently has 8 portfolio managers, who normally work as a team across the various funds that they manage. They are physically located in Singapore, Hong Kong, and London, and most have worked in the team for the majority of their careers. Martin and Richard are usually the ones that front the media and investors on behalf of the team, and Martin is the key responsible person for AEP and DIVA. There is unfortunately not much information introducing the managers in the FSSA website, except for a few short video interviews. I think providing more details or featuring individual managers once in a while can help investors understand the team better. One interesting fact is that all the portfolio managers are also analysts, each covering sectors or geographic regions, and are responsible for the stock ideas that they recommend to be added into the funds that the team manages. Now let's take a look at the share classes available that are obviously different for AEP versus DIVA. For AEP, the retail share class is using the alphabet I, and the base share class is in US dollars. AEP also offers Hong Kong dollars and sterling pound share classes in unhedged version, and Aussie dollars and CNH in hedged versions. Additionally, distribution share classes paid on semi-annual basis are available for US dollars and CNH only. As previously mentioned, distribution yield is not a key feature for AEP, and the US dollar distribution share class has historically been providing only about 2% payout yield. For DIVA, there is only one share class created, which is the retail A share class in Sing dollars and providing quarterly distribution. While this appears as the base currency, do remember that DIVA is a feeder into AEP, so this is really a Sing dollar unhedged version of AEP. The unhedged feature also leads to some performance differences over time, which we will talk about in a while. Given DIVA is designed with distribution yield as a marketing focus, the fund pays about 1% distribution per quarter, totaling to about 4% per year, making it on par with the dividend yields for the popular names in the Singapore stock market. The additional distribution coming from DIVA compared to AEP has to therefore come from capital, which means the NAV needs to be reduced by about 2% to cover this additional distribution payout. So assuming simplified calculation and all things being equal, if AEP generates 6% in a year, DIVA's NAV will grow by about 2% and it will pay out 4% that year. Investors who do not need the income can request your distributor to set it to distribution reinvestment instead, so that you get additional units instead of cash when distribution happens. DIVA is created for Singapore retail investors, and therefore has gotten itself qualified under the CPF investment scheme for ordinary account investments. For more information on CPF investing, do check out the CPF website directly. DIVA, alongside other funds in the same Singapore fund family, also comes with a rather unique feature. which is that it is possible to trade the Singapore dollar share class using US dollars as well. How this works is that FSSA will also publish a US dollars NAV for DIVA that basically uses a daily exchange rate to convert the Sing dollar NAV into US dollars equivalent. Approved distributors can then use this US dollars NAV for subscriptions and redemptions. Do note that this is not a separate US dollar share class, but is using the same Sing dollar share class with the same ISIN, so some people may get confused with that. Therefore, if we look at the performance of DIVA using the US dollars NAV, it will be near identical to AEP US dollar share class. Both AEP and DIVA charge 1.5% management fee on the retail share class. There would be some small differences in the other expenses, as the two funds are created in different structures and in different domiciles. Last but not least, we look at the performance of the fund so far. AEP and DIVA fact sheets have some differences in their formatting, so we make do with what we have. Looking first at AEP, we can observe that the fund had a substantial outperformance of over 300% for since inception cumulative performance. And even on 10-year basis, there is still a small outperformance of about 4%. Do note that the numbers look big as they are not annualized. The fund underperformed the benchmark in the past 5 years, however. And looking more closely at calendar year performance, we can see the main drag was 2023, when the fund underperformed by about 11%, which was probably one of the largest underperformance in recent calendar years. One main reason for this underperformance is the weakening economy in China in recent years, which has led to deratings and sharp share price corrections, especially for the consumer-focused companies that the fund invests in. The team covered this topic in an Insight Overview article in early 2024 and maintained their conviction in the positions as well as believe that the Chinese consumer story will recover again in the long run. We did see some recovery in Chinese equities this year, and the fund has delivered a decent positive performance, although still lagging behind the benchmark. Now, while the 2023 performance had been disappointing, the reality is that many other Asia ex-Japan equity mutual funds had a bad year as well, just that they weren't as badly impacted as AEP, since many other fund managers were not focused on consumer staple stocks in China. Looking at Morningstar's comparison with the peers category, the overall performance of AEP is still above average if we consider 2023 as a one-off. Coming back to DIVA, there is actually Sing dollars and US dollars fact sheets available, so it is easy to compare the differences. Looking at cumulative performance, we can see again that if we refer to DIVA in US dollars terms, the performance is similar with AEP. Most Singapore retail investors go with Sing dollars though, so here's where it gets different. As DIVA is effectively a Sing dollars unhedged version of AEP, this means that there would be performance difference over time due to the FX fluctuations between Sing dollars and US dollars. At times, this can be quite significant. For example, we can see that there is a 7% difference in the 1-year performance and a 6% difference in just the past 3 months. Investors need to be aware of this when comparing against other US dollars based funds or ETFs. Looking at Morningstar's comparison again, we can see there are some years where the fund underperformed, like 2023, and some years when the fund did great, like 2014 and 2018. While the fund is still a notch above the rest on long-term basis, it would be good if the fund can find a way to make some short-term tactical adjustments to the portfolio when needed to avoid 2023's underperformance again. Otherwise, only time will tell if the fund's long-term bets worked out and investors' confidence rebuilt. Finally, let's summarize our findings and start with the good stuff. FSSA is a reputable Asia ex-Japan equities specialist team in the industry, with various funds of long and successful track record. The fund's strategy of going for long-term investing in high-quality growth stocks that has gone through thorough fundamental research has worked out over time, and is good especially for investors looking for long-term investments through mutual funds. DIVA is a product that is specifically designed and created for Singapore retail investors, with all the good stuff like Sing dollars trading, high distribution payout, CPF OA eligible, etc. Having incepted 20 years ago, the fund has exhibited a strong long-term performance that has weathered through market cycles. Let's talk about the bad and the questionable stuff next. The underperformance in 2023 is obviously a problem. The team did explain on the market conditions and reinforce their convictions in their positions and teams. However, the relatively poor numbers is a key factor that will steer some investors toward the other competitor funds. If possible, it would be good if the team can consider some short-term tactical adjustments the next time some major market events happen again, to try to reduce the drawdown. DIVA's higher distribution yield that is not completely from natural equity dividends is not really clearly communicated to investors. And the fund's name gives the impression that this is a dividend-focused strategy. Investors will need to find out AEP's distribution yield in order to understand that the underlying portfolio doesn't really have a high focus to invest in high dividend stocks. While this is not a big problem, it would help if the investors have a clearer picture on what they are investing in and how the distributions are generated. It has been seen that there can be big performance differences between DIVA in Sing dollar terms and AEP in US dollar terms. Perhaps a Sing dollar hedge share class would be something for FSSA to consider, so that Singapore investors that want to reduce FX risk can go for it. This concludes my absolutely biased comments on FSSA Dividend Advantage Fund and the FSSA Asian Equity Plus Fund. Would you invest in the fund or give it a miss? Or are you already invested in it? Do drop a comment to let me know what you think. Additionally, if you find this video useful and would like to see more related contents, please click on like, subscribe to the channel, and share this video to your friends. Thank you and have a great day.